Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. We are coming up on the end of the year, and that means it's time to reflect on 2022, which has, in a lot of ways, been pretty terrible for investors. So to do that with me, I asked Jon Quest to come talk about some of the mistakes that we made in 2022. Jon, how are you doing?
Hey, doing really well, Travis. Thanks for having me.
So I'll start things off here, and I think this is a mistake that a lot of investors made in not only 2022, but 2021, and that's just getting caught up in the hype and forgetting about valuation. One of the things that I've learned I've been investing for over 25 years now, one of my strengths is finding values at times like today, in December 2022, when you can go out and you can find a company that you think is just incredibly cheap and the market just somehow isn't understanding. I remember buying Apple at a price to earnings ratio of like 8 in 2008 or 2009 when you pulled out cash, because for some reason the market didn't think that Apple had the best product in the history of the world with the iPhone. But if you had an iPhone, you could kind of see that future. It's easy to see value to me when the market is down. My biggest weakness is that when the market is up, I don't know when to sell, and I don't know when to see that I've got caught up in euphoria and I just see nothing but roses. I mean, a great example of that is Cloudflare. I think Cloudflare is a great business, but it was at one point trading at 100 times sales, and I should have just gone, whoa, there's no value there. I don't care if you're growing 100% a year. That you're going to have to do that for 15 years for this to be a great investment for me. So I should just take some chips off the table. And I didn't. And I think in general, it is a good idea to just, the saying is let your winners ride. But there's a point that you have to start thinking about valuation. And so I'm trying to process, kind of how I would have done things differently. Because I do want to be a buy and hold investor. I don't want to look at my portfolio on a day-to-day basis or even a weekly basis. But there is a point where I need to go, hey, this has gotten out of control. And I didn't do that in 2022. And that's absolutely my biggest mistake. What do you think, Jon?
I concur with a lot of what you're saying. I would say that if we were talking about biggest lessons of 2021, I didn't realize how long the market could stay irrational. So I think that I started off 2020 very much saying, okay, that's overvalued, that's overvalued, that's overvalued. And things just kept going up and up and up for a very long time, to the point where Cloudflare is trading at 100 times sales. And it makes no sense to me. But then again, I didn't think it made sense at 50 times sales. Yeah. And yet it's doubled since here. So I started feeling like I was the one wrong. Made a lot of investing mistakes in 2021, actually, as I don't know if you want to call it FOMO, fear of missing out, but I started saying, I've held this line on saying this is overvalued, that's overvalued for so long now, and I've just been wrong. Started buying into some of the stocks that I had valuation concerns and was burned very badly. Fast forward, okay, now we're in 2022. March, I took 2 weeks off for personal reasons. However, during that time, I spent some time kind of going back to the basics and really doing a lot of research on Buffett, reading through a lot of his old annual reports to shareholders, his biography as well, and really just kind of regrounding myself in the basics of investing through one of the greatest to ever do it. And at that time, I really started developing a strong conviction in the stock Crocs. So I started buying Crocs in, I believe it was March of 2022, at around $65 a share. And I quickly made it 5% of my portfolio. Now, I do have an arbitrary rule that I do not let a position get above 5%. Well, I don't buy a position that's greater than 5%. If it appreciates, goes up to 10, 12%, I'll hold. I have no problem with that. But as far as buying the position, I stopped buying at 5%. It's arbitrary. Now, this is my biggest mistake in 2022 because my conviction in the value proposition of Crocs was astronomically high at 65. And it fell down below 50 even hit a low of 47, I believe, but below 50 was the point where I said, I need to double up on this because my conviction in the value proposition is so high. And yet I had this arbitrary rule of 5%. And so I did not act on my conviction, which this wasn't FOMO, right? This wasn't fly by the seat of your pants. This wasn't I woke up and decided something. No, this was developed over several months building this conviction. And when it fell below 50, I really wanted to double up, but I had this arbitrary rule that I don't invest beyond a certain percentage point. And it has doubled, more than doubled from those lows. So dollar-wise, that was a very big mistake, not buying more of a stock that I had a lot of conviction in when I really felt like the risk-reward balance was disproportionately tipped in my favor.
How do you, putting these two concepts together, I'm just looking at some of the stocks that have done poorly in my portfolio over the last year. And another thing that I think I'm struggling with right now is what are stocks that I have conviction in that I need to now double down on?
Yeah.
And what are the ones where there was this FOMO, there was something that was kind of fictitious, there was an artificial high that I shouldn't have been in the first place. So a couple that are popping up to me, Snap. In a lot of ways, I like what Snap is doing. I understand the fundamental challenges that they're going to have in especially today's advertising environment. But gosh, is that one of those that I should just cut bait? Or should I double down? And I've just kind of done nothing because I'm like frozen because I don't know what my opinion should be. Zillow's another one. I think Zillow's a great business. I bought in thinking that iBuying was potentially a great business. It was potentially something that could, provide multiples of returns for that company. That was incorrect. But do I just reassess it now at today's price and maybe double down? Or do I just say, a loss is a loss? How do you think about that? Because I think this is kind of this struggle that we all have as investors, trying to figure out what's conviction and what I've gotten wrong.
So for me, again, it was going back to the legend himself, the Oracle of Omaha, Warren Buffett, and how he so clearly articulates and boils down investing in the simplest of terms. He really has a gift for that. But right, what is the only reason that you'd invest in a stock? The only reason that you put money into a stock is because you have the expectation of getting more back later. And so that's why he's looking at cash flow, right? You're entitled as a shareholder to the cash flow of the business. And so at the time, Crocs was trading, when it was under 50, it was trading at something like 3 times its cash flow. Okay. And here is a business that is growing by leaps and bounds. And you look at the popularity of the brand, it's rising. But let's just assume for a minute, that the cash flow doesn't grow over the next 4 years. Well, in that scenario, it has now generated more cash flow than what I bought in at, if that makes sense what I'm saying there. And so
as long as they're returning it to you and through either buybacks or
right, you are assuming competent management who's not just incinerating the cash flow and doing things with it, but over the track record of Crocs under the new manager, I forget his name off the top of my head, he assumed the CEO role in 2016, I believe it was. Under his tenure, yes, very much share count going down and the revenue going up, the profits going up. And so it's exactly what you want to see. You assume that's going to continue since it's the same management team in place, and grounding yourself in that Buffett way of thinking about the cash flow. And I intend to hold the stock for 5 years, right? And so there's going to be more cash flow. Everything that I can tell right now, the cash flow is going to be greater than what I'm buying in at this price. That is where I feel like I had the conviction to double down on that one, even though it was down significantly on my cost basis at that point, right down from 65 to 47. That's a pretty substantial drop. What is that, 35%, 40%, somewhere in that ballpark. Other companies where they still have to prove out the business model a little bit more, or where the cash flow is still lacking. For me personally, I think about Lemonade. Lemonade, that's down a lot for me. It still does have a lot to prove as far as the business model goes and as far as the future cash flow goes. And that's a company for me that, as I look at an inflationary environment, right, your cost of insuring things, let's say somebody has a claim, guess what? It's going to cost more to cover the claims of that. Insurance isn't a great business to be in an inflationary environment because of that dynamic. And so that was not a company where I said, I think that the cash flows here justify doubling down on this at this price. I think that it still has to prove out the business model first, and I think it still has to turn the corner on profitability before it becomes a double down candidate.
Another thing that I'll just kind of bring up, I think we probably both have learned a lot of lessons, is at least understanding what the macro environment is for investors. So what is quantitative easing's impact? What is the Federal Reserve's impact? Because these are things that, we could all see coming, but I think we were probably both in the same boat where you're looking at it with rose-colored glasses and going, yeah, but this company is growing revenue at such and such a rate, or has strong cash flows, or they'll make it up, on the back end. And suddenly when interest rates go from 0% to 4% or 5%, it really changes the game. And there's a lot more fragility in a lot of the particularly software companies than I think we probably thought. So that's something that I think is going to be in my mind more and more in the future. I hope that it doesn't sort of freeze me, because I think right now maybe the market is overcorrected to the downside as far as worrying about interest rates. And that's why we've seen a bunch of these companies like Crocs, like Axon, come off of lows, because investors are going, okay, wait, this is still a great business. They're still generating cash, or can generate cash. Why are we crushing this when we're also crushing unprofitable companies? It's the unprofitable ones we need to be worried about, not the ones that are still generating cash or have cash on the balance sheet. So, but I do need to, add that to my framework, is just thinking more about the macro and what the Fed is doing, and now thinking about China, and because I think that has a lot more impact than maybe us individual stock pickers would like to think on a day-to-day basis. So, well, thank you, John. Can I
just add one more thing here to what you're saying, is that there's a lot of Monday morning quarterbacking going on right now. So a lot of people sounding smart, explaining what has happened when they were not there to say that it will happen. And so I don't want our viewers to get to the end of 2023 and say, in 2022, I started listening to the Monday morning quarterbacks, and that was my biggest mistake in 2023. So like you said, we knew that the rate hikes were coming. We knew it. We knew it from a mile away. And yet it's only been in the past 6 months after it happened and after the market plunged that I've seen all the explanations on why rising interest rates correlates to declining stock prices. Where were those profits back in 2021 when we knew that the rate hikes were coming? In reality, a lot of us are learning this as we go. And so,
because it's been 40 years since rates went up. Like, it's been 40 years.
And I'm 38.
Yeah.
So it's a once in a lifetime event so far for me, literally.
Yeah, and I think we are going to have to rethink a lot of different things. There's going to be a lot of fallout over the next few years. Things that we didn't know that were ingrained in our brains, whether we're talking about founders who have never run a company to be profitable because their cost of capital was zero, and there was always another pot of gold at the end of the rainbow if they could, get to Series B or Series C or IPO, or it's investors who are now having to think about price to free cash flow multiples, or what's return on invested capital. These are all concepts that I think we think about and talk about a lot when we're in the markets, but maybe we've been focusing more on growth and less on, hey, how much money are you making? And maybe we need to shift a little bit more back to that. So, that's maybe a little bit healthy, because 40 years of falling interest rates is probably not going to happen again in our lifetimes. But we will see. Well, thank you for going through your biggest mistakes and lessons from 2022. And here's to a better investing 2023. Thank you for watching. Leave your comments and mistakes, lessons that you have learned in the comment section below. Give this video a like and follow Rive Investing for more great investing insights, and we'll see you in the future.